Hey, I'm Dave,
And I'm Paul.
and this is the Wealth Warehouse Podcast. Well, thanks for joining. Hey, we brought Scott McKay on. You guys may recognize him from one of the episodes a few weeks back, maybe several episodes back. And it's funny, I have another client who after listening to that, said, "Hey, I want to do the same thing. Can you put me in touch with Scott?" So, thanks for talking to him. Pretty cool. So we'll let Scott kind of give his story tonight too. But we also got a bunch of questions, even already, of course, from Steven. And then we got some that were emailed a couple days before, or a couple days ago. But we'll handle those too. And if you guys got any questions as we go, just throw them out there. We'll just kind of do a free for all Q&A here. But Paul, you got anything for the crowd?
No, thanks again for attending. It's good to see everybody. It's nice to get together for this 1 hour every month. And again, if there's any topics you'd like us to cover specifically, just let us know. You can reach out via email or a comment on the YouTube side or whatever. So,
Yeah. Scott, does it matter if we start now or catch you after a few questions? Are you time limited?
Good. Yeah, absolutely.
Okay. Well, I thought, let's see, I got a couple. Oh, Kathy's here, so I got your questions, Kathy. We'll answer those, and we got some from somebody else who is not here, it looks like. So why don't I just run down these questions real quick right now, Paul, and we can start discussing these.
sounds good.
So we got one from a current client. He says, and this may be, I mean, a lot of these will probably apply to several of you, but where do I store my capital as I save for each policy's annual payment? I have 4 policies and annual premiums are due in different months. In total, I pay about $42,000. So I plan to save about $3,500 per month. My question is, what do I do with the money I'm saving each month to be prepared to pay my annual premium? Right now, it sits in a savings account that I just add to each month. Curious what you and other people do as well. So, everybody knows there's different ways to pay your premium. You got annual, which is the most efficient. You got monthly, quarterly, or semi-annual. Paul, how do you pay your premiums?
Annually.
Yeah,
Yeah.
same.
Actually, full disclosure, my kids' original whole life policies that I got through First Command, those are paid monthly, I think, but they're so tiny, I don't even. Anyway, so
Yeah.
annually is what I prefer, what I do.
Yeah, me too. That's what I prefer. So the question is, if people are paying annually, presumably you've saved up money, and then you get a policy and you pay the full premium right away, and then you spend the next 12 months saving up premium so that you can make year 2 annual payment. So what does Nelson say? Your money has to reside somewhere. So that poses the question, where should I be putting my money while I'm saving it up to pay my annual premium? It's a pretty common question. Maybe some of you guys can answer too. Paul and I don't have to answer all of these, but does anybody here pay annually and have a plan for how they're saving that money throughout the year?
Yeah, Dave, it's got, so I've got a couple of large policies similarly, but as a business owner, we're constantly recycling the cash. So typically what I'm doing is I'm using my premium, I use my retirement, my VA, all that stuff as it comes in every month. I just use that, pay down policy loans that are out in other investments that are going to return at some point anyway. And then, if it gets to the point, and then what I'll end up doing is, say, I'll keep the last, month or two's worth of VA, retirement, all that stuff out. And then if I need a little bit, I'll just take a policy loan to finish. I'm not using policy loans to pay premium. I'm just using all that money to pay down policy loans that are doing other things for me. So things that are in apartment syndications or in the dump truck thing out in Utah or wherever else I've got money invested. Um, and so I just continue to cycle it.
Yeah, sounds like, yeah, you're just doing basic cash flow management instead of using a savings account to do those things. You're using your your policies.
Yep, exactly.
Yeah, I think that's
Yeah.
great. So that's good. Anyone else have a more or less? That's not complex either. It's quite simple, right? Your money has to reside somewhere. Does anyone have something different? I tell people. I'll tell you what I tell people to do. That are new to this process is interest rates aren't too bad right now. You get a high yield savings account that's paying 3 or 4%, maybe even 5. Just put it there. That's what you were doing presumably before you discovered IBC anyway. So it's not much different, right? And there's nothing wrong with that. Keeping money in other people's banks, yes, but it needs to be somewhere.
Right. Yeah. And I
I
like
think also,
what, go ahead,
sorry, I
Scott.
was just going to also say like the deposit fund depending on which company you're with, they have pretty good interest rate on what they'll pay you for inside the deposit fund. So since I did my investment or since I got my company to give me a large chunk of that 401k match, and I just threw it in there because that was the deal I made with the company is I'd put it in the deposit fund. That's got a pretty good return. Um, for as far as it being a savings account, and I'm going to use that money for premium anyway, so it's not like I need to access it or pull it out. But I'm pretty sure you can still, if there was some kind of emergency, I could get a hold of the company and pull money out of the deposit fund. But so that's another option.
Right. You would likely have to surrender that particular rider to get the. I had a client early on back in like 2020 put money in it by mistake, and so yeah, we just surrendered the rider and they sent him a check, so it wasn't a big deal.
And that's actually where your money's going to go if you try to pay your premium
Pay
early.
early. Yeah.
Because another common question is, can I pay I've had my money saved up, like it's ready to go for year 2, but your premium payment's 2 or 3 months away. Can I pay it early? Sure, but they're not going to apply it until your anniversary date. So it'll go into the deposit fund and just sit there until your anniversary date. Then they'll pull from that and apply it to your premium. But I want to go back to what Scott had said. Your money has to reside somewhere. Yeah, put it in a high yield savings account until the next premium comes due. But if you have outstanding loans, I've had this come up where clients have said, "Hey, I have these outstanding loans," and I say, "Well, do you have any money in savings?" "Well, yeah, I'm saving that up for the next year's premium." Well, why wouldn't you just put that back towards your outstanding loan? Your money has to reside somewhere. It's much better. My first thought, anytime I have cash just sitting in an account that I don't need to cover a bill, an expense, my mind automatically goes to, do I have any outstanding loans? If so, it's going back to those outstanding loans right away. Because it does a lot for you. One, your money's more protected. It's back with the company. It refills your available cash value, so you can borrow it, borrow against that cash very quickly if you need it. And then you're not paying any interest on it. So it might as well go towards your loan. And like Scott said, if you need to make up the difference to fund the full annual payment when that comes due, you can take a loan to fund the base premium. That's completely acceptable if you don't have it all saved up.
Yeah, I completely agree. Nothing wrong with that.
All right. Any other input on that one? Or we can move on to the next. All right. Well, I got questions. We got somebody here on the call. You can identify yourself if you want to, but going through becoming your own banker again, which right there, I love hearing that. Like, I'm going through the book again. Good. It's not a one-time, it's not a one and done. Keep it on your shelf and go through it. Like Paul and I always have it handy. Going through BYOB again, I came across the subject of policy loan repayments. Nelson says we should make loan repayments that are at least equal to or better than the general investment portfolio of the company on page 22. Can you explain this? And then right after, we can't pay on the policy loan We can't pay more on the policy loan than the amount borrowed plus interest charged by the company, right? That's correct. You can't pay more than your premium and your outstanding loan balance plus interest. True. But what did Nelson mean? So if you guys had your books handy, you can look on page 22 of the 5th edition where he says, I'll just read the actual paragraph here. It says, furthermore, the policy is engineered to become more efficient every year, no matter what happens. Parentheses, that is, if the owner does what is called for in premium paying, loan repayments plus interest thereon that are at least equal to or better than the general investment portfolio of the company. Little confusing. So good question. Paul, you want to help clear that one up?
Sure. We were talking about this earlier, but if the life insurance company is charging you 7%, and you're the type of person that's paying like a monthly amortized payment, like you've calculated, all right, I've taken this loan, I'm going to divide this by 12 months or divide it by 3 years, however you do it, and pay back the company that way, that's the interest rate you should use to calculate your payment, right? We could go a little bit deeper, and maybe, I don't think we should, but people out there in the wide world, you see it in these different Facebook groups, they'll say, oh, the loan rate at this company is this, or the loan rate at this company is that now, and it's, well, yes, right? Think about it. When Nelson wrote this book, the loan rate was probably 8%, right? When he was on his knees praying in the early 1980s, when prime was at 21.5, he was getting money at 8%, right? But the loan rate protects the dividend. It helps protect the company's portfolio, right? So the policy loan rate has to be competitive, right? Because it's a part of their portfolio. It's part of the company's investment portfolio. So it needs to be able to compete with what they can get in their other investments, right? Out there in corporate bonds or whatever. Does that make sense? Otherwise, if they're only charging 4% or 2% on a policy loan, well, that part of the portfolio would now be a drag on the company's overall investment portfolio. So it makes sense. Like people are like, oh, you've heard me say in the podcast a million times, I don't care what the policy loan rate is. I know it's not going to be lower than 0. I now know it's not going to be greater than 8. I just don't care what it is that much. Some people do, but I don't.
Yeah.
Anyway, that's why.
I don't spend too much time on the details on that. And then repaying it. So it kind of gets back to the question of repaying that loan. Are you amortizing it, adding the interest? If like Nelson says, if a bank's going to charge you 5% on a car loan, but you're going to pay for it with a cash value loan, you might as well charge yourself 10%. Now that extra percentage you're paying back to the company, that's not extra premium being added over and above your annual premium and your loan repayment. What that just means is you're just paying that loan off quicker. You're going to pay it off quicker, and then you're going to be piling cash in somebody else's bank after that, and then you may realize, hey, now I need to put this money to work in another policy. I need more premium to pay because I paid it all back, I'm paying my premium, and I'm still piling capital in somebody else's bank.
Right.
So you'll realize it's time for the natural expansion of the system.
Yeah, and moreover, on top of that, let's say you were in the scenario, we had a policy loan out, and you could only pay, let's say, your base premium and whatever rider fees that you have until you serviced that loan, right? You wanted to play honest banker and service that loan. Now you could take that extra money, now that the loan is paid off, right? Now you could take that extra capital and then do some catch-up PUA, right? So that's how you add additional capital back into the policy, which Nelson mentions on page 58 in the addendum. So, but don't make it so complicated, right? You get a loan out, make payments against the loan. Pay your premium, make loan repayments. Pay your premium, make loan repayments. It's it. It's meat and potatoes. Super simple.
Meat and potatoes. Yeah. What Paul and I are both along the same. We pay our loans back the same way. When we have extra cash that we don't need, it just goes back towards a loan repayment. I don't have a schedule. Some people do.
Either.
Some people maybe need a schedule. You can make it automatic, so they'll pull straight from your bank account automatically every single month on the same day, the same amount. So you can be kind of just set it and forget it. Or you could be like us and just, I've got cash available that I don't need right now, pay it back. Or you could do both.
So he was mainly referring to someone who wanted to be on a payment plan and would pay as if they had a bank loan.
Mm-hmm.
That's how that's how he's trying to get people to think about it, right?
Okay, I get it. That's good.
Yeah, that's a great.
Yeah.
I mean, it's pretty obscure. It's good. Definitely a rereading. That's excellent.
Yeah, I'm getting more out of the reading this time. It's
for sure.
starting to click, so it's been fun.
That's good.
Good. All right, and then we have another one here. Kathy, you ask about, Nelson says, buy all the life insurance on yourself the company will issue, and then all the persons you have an insurable interest in. So what are the limitations on the number of policies a company would allow for a single person? And, if the limits are based on your income, would they allow you to take out policies on others? So everybody has what's called human life value. The insurance company, and probably all of you have heard us say that, the insurance company will calculate what your human life value is, how much death benefit you can qualify for. And it's a factor of your age and your income. And once they determine that, let's say it's $5 million. Well, you get a policy for $1 million. That means you still have $4 million of human life value available that you can get more policies until you've maxed that out. So the number of policies don't matter. It's just that total death benefit that matters. So you technically can't be overinsured.
Correct.
There's really no
and
such
you
thing.
need the ability to actually pay the premium. That's the other thing the underwriters are, of course, looking at is, okay, well, how is this person, they've already got 10 policies paying this much premium. It doesn't matter whose life it's on, but they're the owner of 10 policies paying this much. I would use myself as an example. I own a bunch of policies. I'm paying this much premium. They're going to look at financially, can my income handle, yes, I get the human life value available. Great. So we check that box. But also the other box, can he pay this premium for a decade? Or can he pay it for 20 or 30 or 40 years? So they're going to look at that really closely as well.
Yep. Does that make sense?
Okay. Yeah. So there is a limit when you guys talk about, well, if you have extra cash, start another policy. Well, yeah, you can do that up to a certain amount, but they're still going to look at, like you just said, your income and ability to pay back.
Yes, absolutely.
Okay.
Yeah. And when you run out of human life value on yourself, you've completely maximized your personal insurability, then it's time to look at other insurable interests, which could be kids, could be grandkids, could be business partners. Could be, if you're a church, it could be anybody who's a potential donor. Like churches can insure, members of the church. You can insure key employees, all kinds of people. Yeah, but first, I always say try to maximize yourself and then go to insurable interests.
Okay. Thank you.
All right. We got some here in the chat. Paul, you want to go through Stephen's?
Sure. So Stephen is asking about the premium deposit fund, which most, if not all, of the companies have some version of it. There's a couple of different versions we'll talk about with one specific company. So everyone's policy comes with the premium deposit fund, the regular one. You can put up to 2 years of premium in there. Not too many people use it. Some people, like I said earlier, use it by accident. Or they just can't wait to pay the premium, so they'll pay it a couple weeks ahead and it'll get put in there. Show of hands, who's done that? I've done that. I'm the only one. I think there's some dishonest people on here. Yeah. Yeah. Thank you. Two of the guys I went to college with. Anyway.
Then you get a random 1099, at the end of the year.
That's right.
4 cents.
Yeah, no. Yeah, that's a good point. That's income. The interest.
That's right.
On that.
You don't need another 1099, right? So his question is basically, you put some future premium in there. So let's say it's 2 years of premium, and then you graduate unexpectedly. So Stephen, the money that's in the premium deposit fund would be refunded to you. It's considered like I've got a PDF
Unused
Max. It's it's basically unused premium. So that would get refunded along to your beneficiary with the whatever net death benefit. So I think that answers that.
Yep.
Let's see. Is that it?
Well, he's got another one there. I think that's it on the PDF, unless anybody else has a follow-up
Oh.
on that.
Okay, and then
The second one.
okay, yeah.
Reading that one.
So this is a base premium paid up additions question. So let's say someone starts a new policy of $10,000 to the base and $20,000 for a flexible PUA. How can that be funded? I.e., $10K day one and then pay the rest throughout the year as non-scheduled PUA. And non-scheduled PDFs are a thing. So yes, so you could theoretically have a 30K illustrated or 30K total premium designed for you in this scenario, with 10K in this scenario being paid to the base, which you paid right out of the gate, and then you could pay the 20,000 of paid up additions throughout the policy year. Yes, you could do that.
Yeah, it's typically not the way the policy is designed,
Right.
because you have to design it differently to be able to make that PUA unscheduled in the first year. So if that is a concern for you, then you got to let us know before the policy is finalized.
Right.
Like, once
That's going to
it's-
be in our design session. That's a key. That's something key. Like if you get a windfall that you're expecting, like and you want to capture that in the policy. Those are things that we would want to know so that we can build in that. Because once your policy is set, it's set. We can't go back and do things to it. Right. That's the way it's going to be.
Yeah, but so that can be done. In general, I always tell people just to expect the first year has got to be on a schedule, the entire
Yeah.
premium, including the PUA.
Yep.
After year one, you could pay just the base on a schedule. The base always has to be paid on some kind of schedule, monthly,
Right.
quarterly, semi, or annual. And then the PUA is completely flexible at that point.
Yep.
All right. Yep, some podcast recommendations here in the chat. Good.
He's been listening to all of them.
Yeah.
And Stephen, we know all these dudes,
Yeah. Yeah.
like personally.
Yep.
Just saw all of them. Well, yeah, literally every single person he's named. Just ran into all of them at the think tank. So
All right. Yep. And as
I will say, to our credit, not everyone does things the way we do it. I'll just say that.
this is true. Doesn't mean they're doing it wrong. It's just not the way we prefer to do it.
Right.
Rick makes a good point. As your income increases, so does your human life value. True. Because your human life value is a factor of your income multiplied by a certain number of years based on how old you are. So yeah, if your income goes up by $10,000, you may have just added $200,000 of human life value that you can now get more insurance on.
Yep. Oh, and speaking of the NNI and Infinite Banking Initiative podcast, somebody is going to be a guest on that tomorrow.
Some buddies.
Some bodies.
Well, yeah, we'll be recording on that one tomorrow, but it won't be coming out for.
We don't know when it'll
sure.
come out, but we'll be
Yeah.
on it tomorrow.
Yeah. All right. So Ben says dividends are only paid on base. Dividend grows because additional premium payments. How does having the PUAs continue to be worth it? Does the dividend amount buy more base?
Yes. I mean, the dividend adds to the face amount of the policy, right? It makes your policy larger. The majority of a policy's dividend that you get credited every year is going to be from the base premium. No question.
Right. Now, there
Right.
could be different policies, may have different designs. So not every product, when we're talking about product, now we're not talking about the process of banking, we're talking about the product of whole life insurance. Different products have different weighted dividends. Some pay a dividend on the base and the PUA. Some pay a dividend on just the base. Some
Just
don't pay a dividend on the base.
right.
So that product
So how do you
matters.
know what yours is set up as?
Yours is both, but the majority of your dividend is coming from base premium. For sure.
Yeah.
But then the dividend that I'm like when the anniversary comes and the dividend's declared and paid, that will buy more of base, right?
No.
No?
No, wrong.
No. The
Right idea, wrong terminology, I think.
Okay.
dividend is used in the way that we design them. The dividend is going to be used to purchase more paid up additions.
Right.
Okay.
So
So
How does the dividend grow besides the additional premium that's paid to the base the next year?
So the dividend is a very complicated, that's a complicated question on how is like a dividend calculated. It's there. That's why when companies state their dividend rate, I don't really care.
are you asking just why it gets bigger?
No, I mean, I get that it goes bigger because every year I'm making an additional premium.
Okay.
I'm still just trying to, I mean, obviously the 1090 things and stuff, and that's why they don't end up being as good because a lot of the dividend is not paid on the PUA, it's paid on the base. So I'm just trying to figure out, how, it's going to grow because we're going to put more money in every year, but just, I don't know. It's like, why don't you get a dividend on much of the PUA is, I guess the question.
Well, I think from the company's perspective and mathematically, a paid up addition via the dividend that goes back into the paid up additions rider is purchasing, let's say, for every dollar of dividend that you receive, you get $2 of death benefit. So if your dividend was 10 grand, maybe you got $20,000 of additional paid up, meaning no more premiums will be allowed or taken, right? Your death benefit that dividend purchased is paid for, right? Okay. So when there's a rise in death benefit, there also has to be a rise in the present value of the death benefit, which is the cash value.
Okay.
Does that make sense? So math, we can nerd out on math, or I'll probably just recommend a book for you to read.
Okay. It's like I've also been looking at my policy where my cash value is my surrender value is going down, but my cash value is going up because it's using the paid up addition, I guess. That's being used, I guess. Is that
your unused premium is going down.
Yes, yeah, that's it.
And your surrender value is going up.
And I think my whole death benefit is going down a little bit, but my cash value is going up.
Now, your death benefit shouldn't be going down.
Everything is rising. The only thing going down is your unused premium. And all of the unused premium, that we get this question all the time, is if you were to quit today and surrender the policy, right, that unused premium would get credited back to your surrender value. Okay. So it's part of your surrender value. So as the days tick by, by the time your anniversary is up, that unused premium will go to zero.
Okay.
And then it'll reset after year two premium. So anyone has the unused premium question, that's what it is. It's just what would be credited to you in addition to the surrender value.
Okay.
If you quit, which none of you are going to quit.
Right.
I did have another question that was ahead of it. I don't know if you were purposely wanting to save that one for later.
Oh,
no, just haven't got there. Go ahead.
Okay. Well, so I was listening to the Wealth Warehouse because I'm all caught up on yours and I have a little more time to listen when I'm cutting grass and stuff. So they were talking about it was an episode about secure cash flow like the ultra wealthy do. And they were suggesting they had a guy on that does premium financing. And they said it sounded like it was more for business people, basically that it's a way to get your policy established now while you're insurable, and also to get it, working, and then, basically allowing to have the room in the policy later on when you have more windfalls. Um, and it sounded kind of interesting. Obviously, I don't believe you guys like the idea of borrowing money to pay premium. I think I've heard that in some of the episodes. But I don't know what you think about in this scenario.
Well, it depends. Everything's great until it's not,
Right.
until that cash flow isn't there. And we know somebody who has significant death benefit.
Well,
Like
yeah, just think about this. You premium finance multi-million dollar,
premiums.
yeah, really million dollar premiums
Yeah.
because based on the illustration, if nothing changes and interest rates are still 2%, then hey, you'll have this thing fully paid up after 5 or 6 years or whatever. You can pay off the bank and now you own it. But if interest rates change like they did, it puts people in a really tough position, especially if anything changed in their financial
Cash
life,
flow,
income wise, cash flow wise. Now the bank is charging 7, 8% on interest. They have to pay the interest to the bank and they have to fund the premium.
Right.
Yeah, it's premium finance. If nobody is familiar with that, not that you need to be familiar with it, but it's where you basically borrow money from the bank to fund a whole life policy or universal life policy, or basically you borrow money from a bank to fund a life insurance policy. The bank holds a collateral assignment on that policy until you pay it back, until you pay them off. So you don't even own the policy. So we're very much against collateralizing your policies, doing a collateral assignment and giving up this financial asset to somebody else.
Right. The whole idea, one of Nelson's rules was to not do business with banks. I think this would fit into that category. I'm not saying it's not for some people,
Right.
but if you want future system expansion ability, a convertible term policy for a 10 or 20-year period is your best bet, in our opinion. We all have them, and I can just snap my finger, create a policy in 5 days, and it gets issued, and I don't have to do anything medically or anything. So that's the best way to guarantee.
Yeah.
Okay.
There's no financial underwriting.
There's no financial underwriting because everything's already been done. It's literally a quick process. So that's how we recommend future system expansion, is just carry some convertible term.
Okay.
That's a good question, though.
Yeah, good question. Like we said, it could be right for some people.
Please
in
do
a
not
certain
do that, Ben.
situation, but
Well, I mean, I'm still, I'm about ready to start working on those kids' policies. So that's
Right on, brother. That's right. We're spreading them out, aren't we?
right. I want to basically make sure all the annual premiums aren't all due like at the exact same time. So,
Yeah.
how long will that take to get going on the kids? Because basically, I want the premium to be due probably in May would be fine. So I don't know if we should start working on it now, if it'll take a month or if it'll take a couple weeks.
If they're healthy, it'll take less than 2 weeks from submitting the application to getting the policy issued.
Okay, so maybe middle to late April we'll start. I'll reach out to you and set something up.
You got it.
yeah. I mean, realize like the company's going to hold that offer for you for at least 30 days. So even if
Okay.
you get it approved
Yeah.
next week, you still got at least 30 days, probably more, to be able to
Okay.
accept that.
Yeah.
Yeah. All right. Well, hey, why don't we turn it over to Scott McKay here for a minute and tell us, Scott, this is really interesting how you got your employer to pay for your life insurance premium. And, that, like I said, that initiated the thoughts in a client of mine who's going to approach his employer to ask him to do the same thing. So if you want to rehash that a little bit, summarize that for everybody, and then if anybody's got questions on what they may be able to do with their employer, it's just another way of thinking like a banker, which is what you did.
Yeah, absolutely. So I work for a small software company in Colorado Springs, and when I joined, the company was about 90 some people. It's expanded now. We're almost at 200. And I had already started all my policies when I retired from the military. And so, my company is very generous. They have like a profit sharing, like 4%. And then they also do a 6% match into the 401k plan. And I didn't take advantage of the first year because, I take my money and I put it into policies and do other things with it. We own a business, we do a lot of other stuff. And so, but after a year, I started thinking about it. I was like, man, based on my salary, like I'm leaving, a good chunk of money just sitting on the table by not doing this. But at the same time, I don't want to lock up 6% of my salary, to get the match into an IRA that I can't touch for till I'm 59 and a half, which is dumb. So I started thinking about it. I went and I talked with my CEO and I just laid out the facts for him. And I said, look, this doesn't change anything for you. You're still going to get the same write-off you would get because it's just going to get tracked as employee compensation on my W-2. There is a little bit of overhead that we had to work through and figure out, which was me working with HR to figure out like what's the best way to do this. How do we set it up? Because mainly the employer had to consider that it has to be available to all employees. You can't do something, depending on your state. Most states have a rule like you can. I know in Colorado you can do like they call it. It sounds bad, but classes of employees. So you could break it up, and I could say, hey, Paul and Dave are in the HR department and Scott's in the program management. So like I can do one thing for them and like I can do a 50% match for these guys and a 40% match for these. But ultimately it had to be something that was offered to everyone. At the time, the company was already getting ready to move the 401k plan to Charles Schwab from the existing company because they wanted to let people had been asking to do self-directed. And Charles Schwab offers that. So we were already doing a migration. So it was kind of an easy time to kind of fit it in. And then, so we worked out was just one of the ways that I sold it to them was let's make it a retention tool for, me to be retained by the company. So I'll do annual, at the end of the year when we're doing bonus and raise and all that calculation, as long as I'm still with the company, HR will calculate 6% of mine. If I can prove that I paid at least 6%, the same amount into a policy throughout the year, then they'll write me a check. I then have to show proof that it goes into a deposit fund for the company. Because we first looked at it and we were going to have, the company send the money to the different deposit fund. But it's like, hey, if, even if 5 people take up on this, now HR is trying to track 5 different policies through 5 different companies and it just gets to be a headache. So it was very simple. It was just, they'll write me a check at the end of the year. I deposit it. I come back and show proof that it went to where I said it was going to go. So yeah, we did that back in December for 2024. And so it just kind of worked out. And again, nothing changed for the employer, a little bit of change with the HR department. But what it enables me to do now is not leave that 6% on the table. And I'm not tying up my 6% into an IRA.
Yeah.
And Dave,
great.
I was able to reach out and talk with that guy yesterday. So I think he's good. I think he's got all the information he needs.
All right. Good. Yeah. I hope that works out for him. I mean, I don't know why an employee would or an employer would say no, especially you brought out the fact that it's a good retention tool. Like, hey, I'm going to be much happier here if you're going to fund my life insurance policy.
Right. I think, and, too, when I talked to him, because we were just talking about it and trying to do the overhead of like, trying to calculate it monthly, it just adds to HR and payroll and trying to do all these different things. So we just said, let's simplify it. Just do it at the end of the year. So if I leave in October, I don't get it.
Yeah.
So I'm definitely, it's something that I got to consider and hey, map that out. But it's a tool that now I get what I want and need, and the company gets, longevity out of an employee.
Yeah, it's a win-win. I love it. And
that was really how to sell it, how to go in and talk to the CEO, or I started with the COO and just, describe for them because they're like, wait, what do you do? Okay, hold on. And then I had to explain IBC and I had to, so it was like, get it all together. Because when you're talking about like, hey, I do life insurance instead of an IRA, they're like, what? And it's like, hey, it's not in place of, it's just, I put it there first and then I go invest it in other things. So getting trying to explain sequence of your cash and all that to people who have no idea what you're talking about. It took a little while, it took a few meetings, but they ultimately, they're business people, so they get the point, and they get the point of needing access to capital, which was, we own a business here in Colorado Springs, we own a med spa. So as we did that expansion, like the need for capital was massive. So it's easy for me to articulate it that way. And, as entrepreneurs, they understood, and they were just like, yep, absolutely. No problem.
Yep. And since it's offered to all the employees, there's, compliance issues that they have to get through with either the state or the federal level, and the company has met those compliance requirements, and that's all that really matters. Like Scott was saying, it's still compensation to him, so the company still can write it off their books as employee comp.
Mm-hmm.
So it works. Yeah, that's all.
Absolutely.
Yeah. It's really
But
funny
I
how many
think
people.
it's also been entertaining, just the conversations that it spurred. Because then once I went through and had to like brief the company on like, hey, this is another option. We did it as one of the talks when we switched over from one company to another, and it was just an add-on where I just kind of jumped on for the last 5 minutes and described, hey, this is what it is. This is how it works. I mean, I probably had 10 people who've now come to me and are interested in reading the books and, learning, trying to figure out like, okay, hey, this is interesting. And I look at it, especially those young, we got 21-year-old software developers who are, their first job out of college, and they're interested, and they're like, wow, this is unique. I'm like, man, if I would have done this when I was 21, what crap, like what that thing would be now. So it's just great. But I have, a guy who's 64, and he's like, this is amazing. This is what I've been looking for. And so it's just, I think just introducing people to a new concept, something that they haven't heard of. It's not a new concept, but it's new to them.
Yeah, it's hard to be too young or too old for this. I mean, we just put one in force for somebody who's 70 years young. So, pretty
Well,
cool.
I mean, now that mortality tables go to 121, I think they're, plenty of time.
Yeah.
Yeah.
Yeah. Well, I like what, you brought up. These guys had no idea really what you were talking about or how it works. I met with a bank president once a couple years ago and told him, he asked what I do. So I told him, and he'd never heard of it before. So I got up on a whiteboard. We were in just a conference room at the bank, and I started drawing on the whiteboard and showing him how it works. And it kind of blew his mind. A bank president had no idea the power of dividend paying cash value whole life insurance.
Isn't everyone at a bank the president?
No, they're all vice presidents.
They're all vice presidents.
Vice presidents, yeah.
And they all hold a status of officer. Because
That's right.
I've worked
It's,
in banks.
executive
Okay.
vice president or senior vice
Yeah.
president or,
Also
staff
known as
vice
the
president.
gopher at the bank,
Yeah.
or a
Yeah.
gopher, I guess, as Nelson would put it.
Right.
And do I assume that this bank president did not know anything about Bowley?
Yeah. He probably didn't know that there's probably a life insurance policy on you, pal.
On him, yeah.
Yeah.
I'd have to
You
know.
don't even know it. Yeah.
Okay. Does anyone have any questions for Mr. McKay here on it's pretty straightforward, right? He happens to work for the right company that had, people with their ears open and able to wanting to help their employees, right? Not everyone works for a company like that, but a lot of people do. So it's something worth exploring, I would say.
I would say it's also just worth, it's one of those things where it's never going to happen if you don't ask to try.
That's right.
I've talked to plenty of people who were just like, well, I don't know if my company's like, hey, like, I didn't know if my company would do it either. But it took
Right.
2 conversations, and they were like, sure, just do these things with HR and we'll take care of it. I was like, great. So I think there's a lot of people who would just go with the status quo and be afraid, like, to rock the boat. It's like, hey man, they're already setting aside whatever. If they're doing a match, they're setting aside that money anyway. Where it ends up, they really don't care.
Right. The answer is always no if you never ask.
Yep.
It goes the same for underwriting. I mean, when I underwrote a 70-year-old, well, let's see what underwriting says. I don't know. But sure enough, they came back, thumbs up, let's go.
Yep. All the math has already been designed into the cost of the death benefit, right? So if you're healthy, the death benefit just costs more the older you are, but it does still work for the company.
Yeah. And for the policy holder.
And
Still
for the policy
building
holder, for the cash value. Yeah, no
Yeah,
question.
access to it. Death benefit, albeit a lot
Just
smaller than if you were 30 years old or 40 years old.
Right.
But
So I kind of tell people, Dave, like, if you're that age, the death benefit and the cash value are going to have a narrow corridor. They're going to be very close together. If you're a newborn baby, the corridor is obviously is quite wide between the premium and the death benefit. But the older you are, the smaller that gap gets.
yeah, because they have to equal each other at age 121. So
Mm-hmm.
you're halfway there. Over halfway there, I suppose.
Yeah.
All right. What else? What else is on anybody's mind? Got some names I haven't seen before. Most of them have their cameras off. Although
Yeah,
Drake,
including
is
this Tammy person. Yeah, Drake.
he one of your guys?
Yeah, he is.
All right.
Drake's down in where? Niceville, right, Drake?
Yes, sir.
Yeah, Niceville, Florida. It's nice down there.
Yeah. Yeah, I'm thinking about taking my kids down to Florida, like a John Maxwell conference in August down in Orlando. It'd be plenty hot down there, but like my boys, my older two are getting to that age where it's time to start exposing them to, some entrepreneur ideas and foster those thoughts and ambitions and, what are they going to do for life? My oldest can't work at Chick-fil-A forever. So I've got to find something else to do. But so I'll be down in Florida maybe a couple times this year. I'd rather go right now.
It's nice right now.
Yeah.
It's gonna be brutal. All right. Is there any burning questions out there? Anything at all? I mean, Scott, I appreciate the quick rundown on that and super helpful. And he's already helped one person. So, but more broadly, folks, it's just it's all about the way you think, right? Scotty was one of my earlier clients. I've known him my whole adult life, and it was just like the wheels turning in that big brain of his, and just, hey, maybe this will work. And sure enough, it worked out. So, I can't remember what episode he was on, Dave. You are always good at, but he was on an episode with us earlier talking about his business and this topic a little bit more in depth. So if you want to go back and listen to that, it's quite a story.
Yeah, it was maybe 15-ish episodes ago, 10 to 15.
Yeah, like 150s.
Yeah. I've got another, he's not a client. He's actually just a friend who had a policy already, who he started thinking like a banker. And at his employer, he had a employee stock purchase plan. So every quarter he could buy stock at like 85% of the price. And they could turn around and sell it the next day if they wanted. There was no legend on it, no restrictions whatsoever.
Right.
And once he started thinking like a banker, he was like, what am I doing? I'm just going to take a loan from my cash value, buy the stock, I'll sell it back the next day, make a profit, pay the loan off, and now I've got cash.
Makes 15%.
Made 15% on my money overnight because he had access to capital and he could max it out, whatever the max was that they would allow him to buy.
Yeah. Yeah, I just did the same thing, 16%, something slightly different, but I'm going to prepay my rent in Tennessee for 6 months, and I asked the landlord if they would give me 1 month free if I prepaid it all at once. And they came back the next morning and said, sure. So I saved myself $2,250, which is about 16%.
16% over
So
like
basically.
you did that like an annualized 16%.
Oh, I can't remember how I calculated it. I think I just divided. Hold on, let me make sure I'm not lying to you guys.
I like to look at that as you save that much money, so it's essentially like making that much money
Yeah.
in a 6-month period. Yeah.
I just divided 1 by 6
Yeah.
because 1 month is free, right? So I got.
Okay.
Does that make sense, John?
Probably. I don't know. I'm not a mathematician.
John's a math guy. Like, I'm gonna get a
John's
math
nodding
question
his
for
head,
like.
so it must be pretty close.
You're spot on, buddy.
Thank you.
Nice.
My goodness.
Not a bad
but
return.
I learned that from. I thought about it was years of talking about this stuff. Years of how Dave and I had talked about that years ago, where he did something.
One of my clients did that.
Yeah.
And prepaid
that's right.
his kid's school tuition,
That's what it was.
which equated to a certain amount of savings. But when you look at it like from an investment, what he would have to put there, and if he had waited a year and got that kind of return, what kind of return that would be. And in this case, it's guaranteed and it's tax free because you're not.
Yep.
That's not income.
Right.
We do that with all our kids' private school out here in Hawaii, and we get a 12% discount if we pay the tuition in full at the beginning of the school year at one school and 10 at the other school.
Nice.
So that is a huge savings, and we pay the same amount that we would have paid if we were paying the 12-month or the 10 months that we have to pay. So we're saving 2 payments also on top of that.
Yeah. There's all kinds of creative ways out there to just be more efficient with the money. It's money you're not losing it, but you're spending it anyway, right? So you lose less. Like financing cars. You don't make money financing cars with IVC. You lose less.
You lose less. Less money slipping through your fingers.
Right.
Right. Which adds up over the course of your lifetime.
Yes.
So another similar one to the school thing is we prepay for the following year's after school daycare and get 10% discount if we pay for the full year's daycare ahead of time. So just some other ways to kind of expand on the school piece.
Yeah.
Yeah. So
Awesome.
what can you prepay and get a discount on in life? The answer is no unless
I
you
think,
ask.
as a business owner, I would say any business is willing to take money now rather than stretch it out. So,
Right.
I mean, package deals, whatever, always going to incentivize you to let's collect that money now versus because you might change your mind, a couple months from now or whatever. But
Yep. The worst thing I ever did with my money was prepaid 1 year at Fort Hood. I paid for 1 year's worth of gym membership. And it was cheap back then. It was almost nothing. But still, I never went.
what, Paul, no way. Come on.
I never went. Oh my God, I'm so lazy. But, yep, that was a waste of like $300 or something, whatever it was. But, yeah, it's fun.
Hey, we got a question here from Rick. When setting up a juvenile policy, can you explain how OPI, option to purchase additional insurance, is set up? Is there anything paid other than the rider fee between now and the time the option is exercised? No, it's a rider, which means it's going to stay that same price until you drop it or it expires.
Right, you have to exercise it too.
You
to
do have to
the
exercise
full
it
benefit
a few
of it.
times to get the full benefit, right?
Right.
So if you go so long without exercising, it might just terminate.
Correct. It's a use it or lose it rider. But the whole point of adding it to a juvenile policy, especially, is so that the idea is to keep expanding the system to accommodate all income, right? Page 48 of Nelson's 5th edition.
Right, because as they get older, they're going to get a job. Things are going to change
Yeah.
for them, so they would have the
And
ability to expand.
and we're not-
They're already guaranteed. They don't have to go back through underwriting.
Correct.
Right? So,
That is correct. And it's not like you're able to add a ton of future death benefit. So the OPI might be $150,000 OPI.
right. Yeah.
Well, that's not going to take a ton of premium at age 22 to
Not at all.
kind of max out, right?
Right.
But still, it's there. It's something. It's a future. It's future expansion ability in a guaranteed manner, and that's good.
So when
And it's cheap.
setting that up, it's asking you for a dollar amount up front when
Yeah.
you're building out the policy.
Yeah.
What?
150.
I don't know exactly. Do you know what the ratio is, Dave?
Oh, how much it cost?
No, meaning
No,
it's going to be relative to the face amount.
Yeah, when you select it, it throws
I
up.
think.
It opens up a box for you to populate.
Yeah,
It's 5 times your base amount or
There you go.
150, whichever is less.
Okay.
5
So you
times
would take
150,000.
whatever. Okay, so whatever the face amount is on the policy that you're building out, you would just calculate it based on that face amount.
Yeah, up to 150,000 max
Okay.
on that rider. Yep.
All right. All right. That makes sense. That's what I was trying to figure out how they correlated. Okay.
Mm-hmm.
Yeah.
Yeah, but that's a good rider that a lot of people have been putting on juvenile policies because it's kind of like having that guaranteed convertible term for yourself. And you can't get term for kids for juveniles, but you can get this OPI rider, which guarantees their insurability later on.
Right. And it's super cheap.
Yeah. Yeah, pretty cheap. All right. Well, it looks like we hit the top of the hour.
Can I want to ask a question to everybody, and if someone feels the need to pop up, please do. But so, was there ever a time in your IBC journey that you thought of your premium as a bill? And anyone can pipe up, one person or a bunch of people.
I think I did for the first couple of years. Like 15 years ago.
Yeah, I definitely did, and was saving money every month to pay the premium.
And then mindset wise, were you like, oh, I got to pay this premium, or was it?
Yeah.
Okay.
Yeah. For me, prior to reading the book, that was it. But I mean, the very first night that I read the book and realized what this was, it hit me that this is no different than starting a business and investing in your own business. So it was, but prior to that, yeah, you look at it as a bill, something you dread each month.
Yeah, I mean, Paul, I would say, especially when if you're doing annual and you're doing a large policy, like, I mean, my first like $50,000 premium payment, with an additional 40,000 single paid up additions, like, oh great, I'm going to put $90,000 into this. Like, and then it's like, until you can actually see the cash value building, I think it takes that time. Or even when you do the first one and it's like, hey, insurance costs money, so you're only going to have access to 66,000. It's like, okay, but it's like, at this point now, I can't, like, now I want to pay. Can I pay premium early? Can I do it? Because I just got to keep the system going and growing. And so I think it takes time for people. Me personally, it took time to see that. I think you can talk about it, but until you actually see the number and have access to it, and you're like, oh, wait, I can do this, I can do that, and you start to think through it. That's when it finally clicks. Like, I mean, intellectually, it's going to happen, but it's still a big check to write. And I mean, after 20 years in the Army, writing a check for $90,000 was probably one of the bigger checks I'd ever written. Now I'm a business owner. I write that fucking all the time. Like, what the hell?
Yeah. So it's like this. I appreciate everyone's, I appreciate
you
that.
write that for your taxes.
Yeah, absolutely.
Right.
No, I like what you said, Rick. It's like starting a business, which is why that's a perfect analogy that Nelson always refers back to. Because, but it's a business that's guaranteed to succeed. That's the difference. So if you could start a business that's guaranteed to succeed, how big would you want that business to be? I love that question.
Yeah, that's right.
Like, I want it to be as big as possible, as big as I can handle right now.
That's right. And I ask that because, sometimes early in the process, people are, I think, psychologically they're thinking this is just another bill, like my cell phone bill or my electric bill or my water bill. And I never thought of it like that. I had been paying some life insurance premium over the years, but I definitely understand it. And what you guys all just said helped me more appreciate that more. Kind of seeing is believing is what I heard. It's like, oh, is the cash value actually going to show up 2 weeks after I pay the premium? Well, yes. I told you it was good. Oh my God. Of course it is. And then, of course, this is whole life insurance. It's not anything fancy. It's an old, kind of boring, reliable product. It's not.
Yeah, Paul, I think there's also that, instant gratification thing. It's like, hey, I can deposit a check for $50,000 to my bank and it shows up today. And it's like, hey, I make this payment and it's like, I got to wait 2 weeks. Like,
gotta wait 2 weeks.
You kidding me? It's like, or you could call them and they'll, move it faster for you. But it's like, there's that just kind of, until you see it in action, I think until you've experienced it, there's always something that's just going to be a little nagging, like, is this true?
Yeah, no, these are good comments. I'm actually going to share these with somebody, so it's helpful.
All right. Well, hey, thanks for stopping by, everybody. Always enjoy the conversation. So we look forward to having you guys back next month. And hey, until then, control your capital.
Or somebody else will. Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.